Today, we would like to present the case about portfolio risks over time. Our team members have me, Shotika, Busulakam, and Navalat. Our agenda for today, first we start with the stock selection and portfolio construction. Then we will talk about risk and return analysis. And then lastly, we talk about price return and risk forecasting. First, we will start with stock selections and portfolio constructions. The step of stock selections, we select the stock from that index risk, and then we sort the list for offset stock by PE ratio from highest to lowest. Then we select to use 3-year periods from 2017 and 2020. Thus, we exclude the stock that do not have the data over 3 years period. And lastly, we pick top 5 from the ranking after we exclude the data. The stock relation, we have 5, which is BDMs with PE 37.07, CPSC PE 45.31, IBT PE 75.65, AOT PE 40.28, and VGI PE 51.46. The process of portfolio constructions, after we gather 5 stock that we would like to use to construct our portfolio, we calculate daily and annual return of the stock from the daily stock price. And we separate portfolio into 2 types. First is equally weighted with 20% each. And another is optimal weight using solver by having objective to maximize Sharpe ratios. And after that, we can compare the risk and return later on. This is our portfolio weight. The first, as I mentioned before, that we have 20% each for 5 stock. However, optimal weight, after we calculate using solver, we have 50% on CPSC, 40% on AOT, and 29% on VGI. This is the stock return series. As you can see that the allocations stock we put on our optimal weight is the top 3, which is the GPSC for the first ranking, VGI, and AOT.
And now let's move on to the risk and the return analysis. Okay, let's see our portfolio's performance analysis. As you can see from the number here, our set index, which is our benchmark for this analysis, it gives us the return with a negative 3.69%, which when we compare with the portfolio A and B, it can be implied that our portfolio both can outperform the set index. But when we compare with each other, it seems that the portfolio B is outperform portfolio A. As we can see from the value of the expected return, it is 29.18%, whereas the equally weighted portfolio is only 16.80. And from the alpha value, it can be implied that the portfolio B can generate excess return of an investment relative to the return of the benchmark index, which is the set index here. It can generate higher than the portfolio A. So we can simply say that the optimal weighted portfolio can outperform the market and an equally weighted portfolio in the return term. Next, let's take a look at the risk analysis. From the standard deviation value here, we can see that the portfolio B has higher risk of the portfolio than the portfolio A. And also the portfolio B and A, of course, is going to have the higher risk than the set index. And for the beta value, it shows that portfolio B has more systematic risk than portfolio A. Now let's move on to the risk-adjusted return. From the Sharpe ratio value, we can see that portfolio B, again, it outperformed portfolio A in terms of the return per portfolio risk. And as the same fashion, Trainer's ratio also show the value that the portfolio B has a higher return per systematic risk than the portfolio A. So we can conclude it from here that the optimal weighted portfolio outperform both of the market and the equally weighted portfolio in both absolute return term and also the risk-adjusted return term. Now let's moving on to the value at risk analysis. From the value here, we can say that with the initial value of 1 million baht, we can be confident with the 95% that portfolio A here not gonna lose more than 25,784 Thai baht. Whereas portfolio B, the highest of loss is 31,195 baht. And with the 99% confidential interval, portfolio A is not gonna lose more than 36,530 baht, Thai baht. And portfolio B is not gonna lose 44,340 Thai baht in a daily trading. And we also have the value at risk at the various time frame here. As you can see from the table, most of the numbers here are in the same fashion. Optimal weighted portfolio seems to have higher value at risk numbers than the equally weighted numbers. Than the equally weighted portfolios, except this interesting number here with the time frame yearly and 95% confidential interval. It's very interesting because optimal portfolio seems to outperform equally weighted portfolio because it has lower value at risk. But for the rest of the time frame and the confidential, it yields the same result, which says that optimal portfolio is outperform equally weighted portfolio in the risk term. Now let's take a look at the serial correlation analysis. As you can see from the top two graphs here, this one is the graph for the optimal portfolio. It seems that the pattern is quite scattered and it doesn't show significant correlation at lag 1. But whereas the equally weighted portfolio, the pattern seems a little bit stronger than the optimal portfolio. And at the lag 1, you can see that it has the significant correlation than the optimal portfolio. So later you will see in the forecast that we're going to use the Garch model with AMA order of 1-1 to forecast this equally weighted portfolio. Whereas over here, lag 1 doesn't show any correlation. So we're going to use the Garch with AMA order 0-0 to forecast. So, and the bottom two graphs over here we ignore the positive and negative sign of the return, and we only focus on the volume and the momentum over here. And it really shows that the momentum is persist for both equally weighted and optimal portfolio weighted for quite some time. So so all of these graphs can justify the Garch model to be used to forecast our return in the future.
Okay, so the last part is the price, return, and risk forecasting. First, for this slide, this is a stock forecasted volatility as of T is 27 May 2020. And you can see that the 5 stock that we pick, the 4 of them, BDMs, VGI, AOT, and IVL, have the downward pattern for their forecast volatility in the next 10 days. However, GPSC have the upward trend for its volatility. And this slide is the volatility or Gauge model. As you can see that for the portfolio A, which is equally weighted, the volatility in the next 10 days is higher than the volatility of portfolio B, which is the optimal weight. Same as the volatility for the next 100 days, portfolio A have higher volatility than portfolio B. And next, for the pink table, this is a forecasted price of 5 stock and the forecasted value of portfolio A and B, which is in the million baht. For the next 10 days, BDMs start the price with 21.86 and then it go down to 21.74 in the next 6 days, and after that it go up to the 21.79 in the next 10 days. For the 4 stock, IVL, VGI, GPSC, and AOT have the upward trend for their price in the next 10 days. And for the value of portfolio A and B, you can see that in the next 10 days, portfolio B have higher value than portfolio A. Next, for the for the blue table, the forecasted return from our using Gauge. You will see that the portfolio B also have higher return than portfolio A in the next 10 days. And for the stock, all of these stocks have upward trend for their return. The BDMs have negative return in first 5 period, and then until the next 10 days they have positive return. And for the IVL and VGI, they have negative return in the first period, and after that they have positive return. And for the GPSC and AOT, they have a constant positive return in the next 10 days. As we said earlier, that portfolio B had higher volatility than portfolio A, and they also had higher return than portfolio A.